stay focused on the issue of credit allocation. I believe in an independent Fed with a dedicated source of revenue, but I just believe the Federal Reserve allocating credits to specific segments of the market helps politicize the Fed, and it also creates problems as it tries to unwind its position when inflation pressures increase. So I would ask this of each three of you: from an independent standpoint, does the Federal Reserve's credit allocation policy threaten its ability to conduct its monetary policy independently?
So very briefly, I believe it raises questions about why an independent agency of government should be taking on responsibilities that are more appropriate for the Congress and the appropriations process. There is not a theoretical rationale for that, just politics. So I think it does raise questions, legitimate questions, and that's why I think we should try to have the Fed do much less of that credit allocation in the future.
In the Sound Dollar Act, we basically limit those purchases to treasuries going forward, those assets, except for very unusual circumstances. Dr. Meyer?
A principle of monetary policy should be neutrality, and that means only operating in government securities. So in principle, I agree with that. Now here's the problem. The Fed now holds on its portfolio about $1 trillion worth of agency securities. It holds $1.6 trillion of treasuries and said it can't buy any more without dysfunction in the treasury market. So this, again, is an attack on quantitative easing. What you're saying is take away that $1 trillion. You shouldn't have done it. Well, I think it had a big impact on the economy. So I think we have to, I agree with you as a point of departure. I would have said exactly what you say. You got to hold your nose, okay, if you're going to buy MBS. It was extremely unfortunate, but I am conflicted, okay, in this particular case, because the Fed has reached the limits, would have reached the limits, has reached the limits of what it can do in treasuries, and its portfolio would be not half as large, but almost half as large as it is today if it didn't have the authority, which it did have, to buy MBS.
Thank you. Dr. Poole?
If I accept all of Larry's judgments about the extent to which mortgage rates were reduced, I continue to insist that that reduction did nothing, or practically nothing, for the moribund housing market, nor did it do anything for the people who were suffering from foreclosures and financial distress and upside-down mortgages, because they couldn't refinance mortgages. So almost all the refinancing that took place created new mortgage-backed securities, and those are the people who were assisted by this policy. Now, who are the people who lost? I mean, if I gained, who are the people who lost? Well, the people who lost, some of them were people living on fixed incomes who had the rate of return on their portfolios reduced. So there's a transfer from them to me. Some of the other people who lost or will lose will be the federal government, because the Federal Reserve is taking a lower rate of return on these mortgage backs, and may actually, in time, as interest rates rise, lose capital values as well. So the program helped me, thank you, it helped me and others in like circumstances, but did very, very little for the underlying core of the problem in the housing market. It was sold for that, doing that, but it did not have that effect, could not.
Dr. Poole, does inflation telegraph its punch? I mean, is there not the belief that, that the Fed has to start withdrawing its accommodative policies and accommodations ahead of inflation taking root? I recall in 2007 in this room being assured there were no asset bubbles, the economy was moving along great. We know what the end result was. Can inflation also take root before the Fed begins to withdraw what is a very unprecedented aggressive position in those mortgage-backed securities?
Well, of course it can, and the issue is whether the Federal Reserve will act in a timely fashion to prevent the inflation from taking hold. 1994 is a really good example. Alan Greenspan emphasized that the tightening of monetary policy that year was preemptive. It was taking place so that inflation would never have a chance to take root. And he was successful, and it did not have an adverse effect on the unemployment rate. So, yes, you want to withdraw the excessive expansionary force of monetary policy before inflation takes effect. And I don't think there's any disagreement here in this panel about that.
I was just making the point, I'm worried the politics, as that begins to happen, will be driven up substantially on the
Well, the politics of that will be that as interest rates rise, as they must when the economy recovers more than it has already, it's going to cause an explosion in the interest expense line in the federal budget, because there is an ever-growing amount of government debt outstanding, and when you start applying higher and higher interest rates to that outstanding amount of government debt, it's going to cause a very large increase in the federal budget expense component. It's going to make it that much more difficult for fiscal policy to get itself on the correct course.
Got it. Thank you, Dr. Poole. Senator DeMint?
Well, I've appreciated the discussion. We're really getting in a much